Over the weekend, we released our new Scalper Volatility Box models for all of our Futures Volatility Box members. In this video, we're going to take a look at the Scalper models and the trade performance that it had today, both with a lens of having no trade rules at all, along with our actual trade plan rules from our normal Volatility Box trade plan for our aggressive, conservative, and doomsday models. Now, if we had no rules and you use just the levels as your trade opportunity, so the cyan line is our point of entry, where the orders are parked ahead of time no matter what, no confirmation signal, nothing of that sort. Stop is outside of the volatility box, and then the target is at a T1 and a T2. That's where this is a table representative of what would have happened just with the raw levels. And what this should really help you with is build confidence in the idea that these models, the volatility box edges, are working even in the scalper volatility box, and they are giving you a really nice edge. And that's where for all of you that have your existing setups, you can start to use the volatility box as an instant framework for all of your trades, right? Things like a pullback on a moving average, things like your moving average crossover, things like your market pulse, whatever your favorite indicator is of choice. We also had members who are using the V-score, right? There's plenty of opportunities, but you can start to have your own confirmation signal. But that's where it helps when the raw levels on their own seem to work. And in today's case, this is about as best of a start to our new scalper volatility box as we can potentially hope for. With our S&P, you had two trades. Both of those trades were good, where you risked a total of 1,000 across both trades. But that was good for a total P&L of positive 1,435. In the Nasdaq, you had two trades, and the Nasdaq had the one loser in which price had also broken outside of the volatility box. But again, with no concept of rules where that tells you to stop trading for the day and be a bit more cautious, you were able to make back that loss with the final trade into the final hour of the market. And same with the Dow. The Dow gave you an entry in the final 5 minutes or so before the market closed. And that's where you had price fall into our entry lines and then bounce almost like a V directly from there. And we'll go through all these charts. But the real gem of today was the Russell. The Russell gave us 3 trade opportunities. All 3 were winners for a net P&L of positive 1,115, giving you a net total for today of 8 trades in total compared to the usual 0 to maybe 1, maybe 2 that we usually see. So you can see that this did achieve the goal in giving us more trades, a win rate of positive 87.5%. You can see that we still maintain the same high probability ratios that we're used to seeing. However, here you can see that our P&L is also much higher, mostly because we had many more trades, along with the dollars risked, but the dollars risked per each trade on a 2-contract basis was not really all that bad, right? In the case of the Dow, for example, over 2 contracts, that was positive 450, with each contract being right around 225 bucks or so. So that compared to our normal risk is much smaller. And this is the entire goal of the Scalper Volatility Box, is to start to now create a rule set that works particularly for these scalping sort of trades. Our starting point is, of course, our normal volatility box rule set. And that's where if we take a look at the trades that set up with that, drastically less trades today, right? We just had one that set up out of the 3 in the Russell, and the others didn't meet our rules, mostly because they were at the edge of an hour of each subsequent hour in which that trade came. However, that one trade in the Russell using our rules was a really good strike, right? You had a positive win rate of 100%. It was almost a zero heat trade, a nice quick 150, and we moved our stop to break even on that second contract, which is where that got taken out. But if that stop was at the original level, the same 3 points that you had agreed to give the trade, then that second contract did go up to our T2, which is a positive 11.3 points. So in today's video, we're going to cover all these trades, but focus on only these 4 markets: the S&P, the Nasdaq, the Dow, and the Russell. Starting with the S&P here, we'll start by drawing our first hour line test, in which we're checking to see whether or not price action breaches either side's entry lines of our scalper volatility box. Now in the case of the S&P, we didn't, and that was our okay to continue to use our scalper models for the rest of the day. And for members who have had a chance to backtest this, or at least go back the last few weeks, you'll notice that this first hour test does a pretty good job for the most part of giving you a heads up when to expect a more volatile day, and to say take the scalper models, put them back on your tool shelf, and instead pull out the aggressive models, giving you that heads up sign that, hey, today's going to be a bit more volatile. You want a set of models that will adapt to the market. Right, and so now with the S&P and with our scalper models giving us the okay, we're looking for breaches. Now that breach comes as the S&P hits our aggressive volatility box right here. You get the edge signal, and that's really it. From there, the S&P starts to bounce higher, giving you not only your first target, which was our risk, which is our entry line minus the edge of the clouds, 4.25 points, 4.25, and our T2 line, which is towards the other side at 13.7 points, right? And so that's where this became a really nice trade. Now, the reason it didn't essentially trigger according to our rules is once we got the edge signal, we didn't get an opportunity to enter at the cyan line or better. Now, something a few members have started to do, which I think makes sense, is using the gray line and the cyan line as a potential entry zone, in which once you get the edge signal, any entry in between that zone starts to become fair game, in which that is additional risk you're taking, but it's additional risk you're taking off of our scalper models, which are already slightly lower risk, right? In terms of greater risk, that adds about 1.25 points to your trade, but would give you an opportunity to try and participate in some of these on a more aggressive scale. Again, this is just for scalping, but that was the one trade that's set up in the S&P. The second one was towards the final close, the final few minutes, where price started to sell off in the S&P. And this happened across the board, the S&P, the Nasdaq, the Dow, and the Russell. And our levels helped us catch exactly these pinpoints, right? So once we bounced into these levels, you had the edge signal, you even had an opportunity to enter at the cyan lines or better, and you then had the really nice, quick, almost V-shaped type follow through from our levels. Now, the reason why this wasn't attractive as a trade is it's towards the final few minutes of the close. It's triggered, I think, into the final 5 minutes. It's not really a time that I'm looking at entering a new position, but it does help to build confidence in these models, knowing that these levels are being respected, and we are seeing at least some sort of a reaction from that point, at least in the minimum amount of our scalper. Now, moving on to the next trade in the Nasdaq was slightly different, right? So now in the case of the Nasdaq, our first hint that we should expect slightly more volatility, we did have a breach. However, with that breach, we did see an equal and opposite follow through before breaching outside of the volatility box clouds, right? So that's the okay to continue to use the scalper models. We're seeing that our price levels are being respected. Now we had our trade come in that 8 to 9 a.m. Pacific hour, where price fell into our aggressive volatility box, and at this point, we're waiting for an edge signal. Now that edge signal didn't come until we had already breached outside of the scalper models, right? That signal came right here, at which point the trade isn't really valid. So according to our rules, this is where the Nasdaq is it for the day for us. We've broken outside of these models. It's time to switch on over to something a bit more aggressive, which, just to load that in, was the better model in terms of capturing the price action in the Nasdaq futures today, right? And so that's where our scalper models gave us that slight little bit of heads up in the morning that, hey, this is going to be a more volatile market. We breached edges, whereas in any of our other indice markets, we had not. And we see that throughout the rest of the day, we did breach. Now, using the no rules method, if you did continue to use the scalper models, towards the edge of the hour, we had the same thing. We had price start to stabilize once again inside of our scalper models. We then had price fall into our scalper entry line. You have the edge signal, plenty of opportunities to enter at the cyan line or better. And in the case of the Nasdaq, that breach came even before the edge of an hour. Right, the only reason why this wasn't all that attractive was, again, because of the reason why we had switched over to the aggressive models once we had the first sign that, hey, we've stopped outside of our clouds before we got an edge signal. Doesn't really make sense to try and risk that capital on the Nasdaq. There's a lower degree of edge. Now moving on to the Dow. The Dow was the least volatile of all these markets, right? So if we start in the morning, we had price just chop sideways. We didn't even have the breach where the S&P had the breach, still chopping sideways. It was just towards the final hour where the Dow 2 sold off exactly into our volatility box lines, and we had that V-shaped bounce from there. And so the Dow was yet another example of just a place where we can start to build some confidence in these models, but was a trade towards the edge of the day. And then finally, the last trade that we'll look at, the market that's the busiest, is the Russell. Now, in the case of the Russell, if we start by drawing the same first hour line test, you should notice that we didn't breach any side's scalper volatility box entry lines. That's your okay to continue to use these models. Now we're looking for a breach, and that breach came as price fell into our volatility box lines. We had plenty of edge signals, plenty of opportunities to enter at the cyan line or better, and we then saw some really nice follow through in the case of the Russell. Now that second contract was taken off at break even after we hit our target in this move up higher, and we then came back to retest really just the cyan lines before bouncing from there. Right, so yet again, our rules here kept us out of that second contract in trying to avoid any sort of minimal loss. So that's something we're going to be working through, just refining, starting to figure out a way to squeeze as much juice out of each of these trades as we can. But in the meantime, it is still nice to be able to take our set of rules, apply them directly here, and still start to be profitable from day one. Now, the second trade in the Russell was where price action hit our cyan entry lines for a short. We even had an edge signal and an opportunity to enter at the cyan line or better. The only reason why this trade wasn't valid according to our rules was because it was, again, towards the edge of an hour, right? This took place after that 50 candle, in which really the edge is much, much lower than, say, a normal mid-hour entry. And that's where we're now just looking and observing to see what happens with price action here. Now, in the case of the Russell, you ended up chopping sideways, didn't go outside of our clouds here before you had really nice follow through and sell off in the bearish side, hitting both your T1 and your T2 on this trade. And that target of the T2 then led to our final entry in the Russell, again with that no rules format, where price fell into our cyan entry lines. You had the edge signal, price took off again without giving you an opportunity to re-enter at the cyan line. However, you can see that you still did get that same fall through in the opposite direction, giving you your bare minimum target of 3 points. And then this trade is still valid for once the markets reopen for after hours, right? Almost all of the indices across the board on that second contract are still valid trades. And so that's where I think the scalper models had really about the best first day that we could hope for it. I'd love to see this continue throughout the rest of the week. All right, so I hope this video helped to give you an idea of the performance, at least on day one, of just a raw volatility box, along with layering in our basic rules, which for the most part have kept us out of trouble, right? One day of missing out on profits doesn't necessarily justify changing some of these rules, but that's where the Scalper Volatility Box is meant to be much, much more aggressive, and it is nice to see that even on the most aggressive scale, this is with no filter, the trades on their own are working, giving you some really nice opportunities to consistently profit from the marketplace. All right, hope you all have a wonderful rest of your day. For all of our Stock Volatility Box members, there is something new that we're working on, which we'll be releasing for the Stock Volatility Box platform this week, which I think you'll really like. And so I'll make a video on that later in the week. But until then, have a great week ahead. Good luck trading and take care.